Hi guys, it's MJ, and in this video I want to speak about credit management. And I'm basically going to be speaking about three things around this. I'm going to be looking at some credit procedures that they go through and how stupid they've been in the past. I'm then going to speak about something really smart and how you can make millions by playing golf with bankers. And then finally, I'm going to touch on a little bit of the darker side of banking and potential collusion that could go ahead with it. So without further ado, let's look at a credit management procedure that was really, really dumb when it came to try and manage credit risk. So we're going to be looking at this procedure, and it's known as the offensive and defensive credit management technique. So what did it entail? Well, what it was we want to try and lend out as much money as possible, but we only want to lend to people who are able to repay it. So what we're going to do is we're going to separate our credit team into two fronts. We're going to call them the offensive, and we're going to call them the defensive. It would help if I could spell properly. Hey, defensive. Okay, offensive and defensive. The offensive team, they were incentivized by the amount of the loans that they issued. So their incentive was to issue loans. So the more loans that they could issue, the better. And what would happen is someone would call and say, "Hi, my name's Bob. I need to, borrow 100,000 Rand in order to renovate my home." The offensive team would say, "Well, okay, how's it, Bob? We've got all your details. We see your salary and everything like that. You're actually eligible for a loan of 150,000 Rand. House renovations, they're quite difficult. There's always unseen expenses. Why not take a bigger loan? You can always repay it back sooner if you don't need it, but it's better to be safer than sorry." And Bob's like, "Wow, that's such good reasoning. I'm going to accept that. Okay, make my loan for 150,000 Rand. So what we're seeing here with the offensive team is they're hard selling. So instead of just lending out 100,000, they've now lent out 150,000. And they would do this by, enticing their clients in order to take out more. And this is a great strategy. It's basically like selling more to a client. Like a client says, "Hey, I want to buy a hamburger." You say, "Well, it will be great with chips and with Coke." You sell more to the client. A very good strategy, except with credit markets, it does slightly increase the risk of default. The more money you lend to someone, the more likely they are unable to repay it. So that's the one thing, is that the offensive team would push to sell more. But management thought, "Oh, we've got this covered because we've set up a defensive team, and we're going to incentivize them or give them a bonus based on how few defaults there are." So they've been incentivized. Their incentive is to have no defaults. And what management's thinking is, we've got one team, they're going to be really aggressive, getting people to take as many loans as possible. We're going to pay them for high commissions, really motivate them to lend money out. And then we're going to set up a defensive team that is going to catch all the bad risk. This is a brilliant plan. Also, they thought. What would happen is that the offensive team was aware of the defensive team. So when it came to filling out the forms and doing so forth and the details and asking, "Oh, how safe is your job, sir?" or "How likely is it that your job is sustainable?" and all these other details, the offensive team was aware of the defensive team. And they were aware because their bonuses would be less than what they thought about, because the defensive team would block them. So they had also a bit of a slight incentive to cheat the form and to make the person seem more creditworthy than what they actually were. The defensive team, they were also, remember, we've got smart people in both of these teams. They were also quite smart, and they also cottoned on to this idea that some of these forms were being cheated or not as honest as they were supposed to be. So what the defensive team started doing is they just started to say no. Offensive team started to just say yes. So no matter who you were, you came in, offensive team was like, "Yes, here's your loan." Then the defensive team looks at it and says no, and no loan is made at the end of the day, because both are pushing for their incentives. This comes to that whole principal agent problem that we've seen in earlier subjects, where the goals are misaligned, so they're going to be doing some weird things. At the end of the day, what happens is no loans get made, and the reputational risk or the reputational damage to the firm is quite big. Because think about it, Bob is really, really upset. Here he is, he's gone to a bank, he's asked for 100,000, they've offered him 150,000. He said that's great, he's gone home, told his wife, they're all excited, and then the defensive team comes along and says no, and there's quite an awkward conversation, calling Bob up and saying, well, actually, we can't give you the loan. So this type of credit management system, though it was great in theory, I mean, people thought, wow, we're going to have one team aggressively marketing our product, another team making sure that they don't go overboard. We're only going to be lending to the best and most creditworthy people, ended up with a system that started fighting each other rather than complementing each other, and it was just a big, big stuff up. Okay, so now we've looked at one procedure that's worked very, very badly. Let's look at one that's worked a little bit too well. Okay, and so remember I made the video yesterday on the credit quantitative and qualitative models. This would be the one that looks at, say, your financials and tries to give out a very quick output. That's what essentially they were trying to look at. But because there was this qualitative feature, the defensive team could rely on the subjective principle and shoot it down due to judgment. So even though the credit score was, say, 7, they could say, no, but we just don't have a really good gut feeling about this. So again, we're seeing one of the big weaknesses in using those credit models. Although one of the credit models that we spoke about yesterday was something known as the credit portfolio model or credit portfolio management. And this one gets quite interesting. Think about it. Okay, you are a bank. Let's call you yourself Bank A. Okay, you're Bank A and you have a rule or a credit risk policy that says you're not allowed to lend more than R1 million to an individual. Okay, you can't lend more than R1 million to an individual. And this is quite a good thing to have in place because you want to maintain diversification. The thought being that it's much safer to, say, lend 5 million to 5 individuals than to lend all 5 million to one individual. That's the idea of diversification. You know, don't put all your eggs in one basket. However, what happens when your top client comes up to you? Okay, let's call him Jimmy. So Jimmy comes up and he says, guys, I need to borrow R2 million to buy my new Ferrari. I've got a substantial business, I'm doing this, but I just don't have the liquidity at the moment to buy my Ferrari, and I really need to buy this Ferrari for my daughter's 21st. Okay, so we've got a daughter's 21st coming up. I need the 2 million. You guys know that I'm good for the money. Lend it to me. Now, Company A is in a bit of a dilemma because if they say no to Jimmy, remember Jimmy's wanting R2 million, they lack or they reduce their reputation with Jimmy, and they don't want to upset Jimmy because if Jimmy starts taking away all of his money from Bank A, it's going to be bad business for them, and they're going to lose a very good client. However, their risk actuary or their chief risk officer has set this 1 million policy rule, and he's done it to avoid, credit crises and all these type of things. So you have a little bit of a clash. Client wants 2 million, he's all good for it, but we've got a credit limit that says we can only give out 1 million. What do you do? Well, remember, customer is king, so you give Jimmy the 2 million. But now you're in this very awkward position where you are overexposed. So how do we get rid of overexposed? Well, we go to Bank B. So Bank B, who's normally our competitor for Jimmy's business and all these other people, we're now going to become their ally. What we're going to do is we're going to say to Company B, we're going to say, we will give you 1 million of Jimmy's loan in return for, say, 1 million of a client that had a very similar situation with you, with your client. And Bank B is very happy with this, because this means now this agreement, the swap that they can do, means that they can now also extend over their risk limits. They can push over them, and they can make exceptions for some of their top clients, because now they have company A in which to swap with. So now both of them, instead of having 2 million risk on Jimmy and say a 2 million risk on, we didn't give him a name, on, let's say, Eric, the banks can come together and swap these risks so that both of them have got 1 million with Jimmy and 1 million with Eric. Both banks have this position. Both banks are now diversified. Both banks are no longer exposed. So this has mutually benefited both of these banks. Now, where do banks do these deals? Well, according to some urban legends, it's actually done on the golf course. So while these bankers are busy playing golf, they're putting and all these type of things, they were talking about, they're in this terrible situation because there's this client who wants a massive loan, but it goes over our loan, our risk limits. And the other banker was saying, oh my gosh, we had exactly the same problem. How beautiful would it be if we could share each other's risk exposure? And so by playing golf, they were able to do this deal. But now in real life, we're not looking at 1 million. We're looking at billions. Now, as a banker, you will get a commission, or you'll get some sort of incentive or a bonus if you can pull one of these deals off, because they are very, very, very beneficial for both of these banks, as it gives them the diversification benefit, which means they have to hold less capital in their reserves, which means they can lend more capital out, which means they can make even more money. So the bank is prepared to incentivize the bank managers to make these trades. And these trades are done on the golf course. So as a banker, you can make literally billions of rands playing golf and not being very good at it, just by doing these dealings. And I mean, trading loans is very much like trading Pokemon cards, because that's effectively what you're doing. You're trading your loans in order to balance or get a perfect portfolio management position. But there's a dark side to this. And the dark side is that two companies that used to be, enemies, Company A and Company B, these two banks used to be in, competition with each other, have now realized that by working together, they can benefit each other. There's mutual benefits, which means this puts serious pressure on the whole anti-competitive rules. Regulations have got these rules to try and make the market fair. But now this becomes under threat when banks realize that it's more profitable for them to work together. And a term that's thrown out a lot is this thing known as collusion. And I mean, just for making this video, I thought for fun, let me go and type in banking collusion on Google and look at the news. And bam, I wasn't disappointed. There's like a whole bunch of stories going on right now. I mean, it's looking at like the 19th of August. That's when I'm recording these videos. What's today? The 21st. But 19th of August was the last business day. And we're seeing that there are news stories happening in Australia, in China. I mean, England, there was the big banking collusion with Bob Diamond and Barclays and HSBC. And it's crazy how banks are cheating the public by working together and breaking down anti-competitive rules. And the reason they're doing so is because they're realizing how they can reduce risk by working together. And this comes down to the whole thing, well then, shouldn't they just be working together? If they can reduce risk, maybe then they can, reduce the prices. But then you get monopoly theory that comes in. Well, if these guys create a monopoly together, then they can have all control on the price and they can, raise it really, really high. And it becomes a very, very emotional thing. I mean, credit management has something that goes back a long way. I remember back in the day, certain religions wouldn't allow people to lend money to other people within their own religion and charge interest rates. This therefore gave the Jewish people a very big advantage in Europe. It allowed them to be the first people to lend to Christians. So Jews couldn't lend to Jews, Christians couldn't lend to Christians, Muslims couldn't lend to Muslims. But Jews found a loophole or something like that, which allowed them in their religion to lend to Christians. And in a Christian-dominated Europe, they were able to set up the very first banks. The name is quite, you might have heard of it, known as Rothschild. And he was able to now start lending money, and credit management started to first take place. And it's quite a fascinating story seeing how bankers interact with each other and the sort of love-hate relationship that they have. On the one end, they're competing for clients, because remember, if Bank A said to Jimmy, sorry, we're not going to lend you the money for your daughter's birthday gift, Jimmy would be like, well, then stuff you guys, I'm going to go to company B. But by working together, they can get past their certain risk limits and their risk management policies. By working together, they can get around that. And like I said, it can be mutually beneficial for both of them. However, that then leads to the risk that they take this relationship too far and they start getting too cozy with each other, and we start having collusion, which starts ripping off everyone. So overall, credit management, this has just been a very quick video. I mean, there's so much to talk about in the subject. There's fascinating stuff from, the really dumb management policies that some banks have put in to the sneaky little games that other banks are doing. It's a phenomenal topic, and I mean, people have written books and have dedicated their careers to just this risk. However, or unfortunately, there are other risks that we have to deal with, so we do have to move on. I know I've been making a lot of credit risk videos these last couple of days, but now it's time to move on and talk about market risk, liquidity risk, and all the other risks that dominate the financial markets. Thanks guys so much for watching though, and please feel free to subscribe and watch the rest of the videos that I've made. Enjoy your evening. Cheers.